Alrighty, welcome back to Daily Day Trades YouTube, where we go over the trades that we made today and why, and the things to look out for tomorrow. If you want to get these videos every day, then please subscribe to the channel. It also helps a lot if you were to drop a like on the video. Moving on into what we did today though. I got a little bit of a late start today, didn't start trading until around noon because I was busy, but I did end up sending this chart out of SPY. You can see here that it's trading between this level of 408 to 416, and that's pretty much been going on for the past week or more. Now, this is pretty basic technical analysis. You can kind of just see it by zooming out, but I did put the lines here for reference. You can see that it did break through 408 and 416 multiple times, so it wasn't like it was a hard stop of support and resistance between these two levels. It was just numbers that came up frequently and tend to be the places where it reversed a trend. The reason I was paying attention to this was because I assumed at some point if it were to break 416, then we would see this continuation down for the rest of the day. Something that makes that move stronger is how many times it hit this level before breaking through it. So when you're looking at price action, the more times that something hits a level, typically the stronger the move is after it breaks through that level. So in this case, we were all over it the entire day and then eventually got one candle straight through it and straight down. So we ended up making a play on SPY. We got puts. We got SPY 404 puts for $1.50 that expire tomorrow. It's a little bit of a risky play, but we were just going to have the stop right up there above 408. So, just as long as you keep an eye on it, it's not a terrible thing to get options that have such a short expiration. You just got to be a little bit careful with it. It ended up working out well for us. We sold those for $2.58 a piece, but only half. So we got 72% on the ones that we sold, and the reason I sold some of those is because I really wanted to have a call side as well. And I'll go into more reasoning on why I wanted to have calls as well going into tomorrow. But that is why I sold them, and then I used some of that profit to buy just a singular $200 play on the bullish side. And if that completely tanks and does nothing tomorrow, then that is totally fine. The puts are still up a considerable amount, probably close to 100% or more. But we do have that one call just in case something doesn't go as planned. By the way, if you do want to get all these alerts, there's a link below that will take you to here. It's in the description. This is where you sign up. You can get a 7-day free trial here, and then it is only $19 after that. If you do the math there, you could have bought one of these SPY puts and paid for 6 months. So that only took you less 45 minutes. About 45 minutes pays for 6 months, assuming that the plays go well. Everyone screws up. So sign up at your own risk. If you hate it during the free trial, then cancel. Doesn't cost you anything. All good. Another play I made was on Roku. I just got some puts for tomorrow on that as well. And since they are for tomorrow, I sold all of them except for one and just wanted to take some gains on that. I think Roku is just one of those companies that's always lagging behind. So in this case, we had SPY, which had a pretty bad day, and then Roku is 3 times, 4 times worse than the S&P. So they're always lagging behind when there is a down day, and that's why I wanted to pick up something that would react even more than the index itself if it were to continue to go down. So in this case, I bought them for 145. And I bought quite a few of them, and then I sold them very quickly after for 175. So I got $30 per contract. That paid for the contract that I had remaining. So now I have about a $200 play going into tomorrow. That was completely paid for by the profits of the contract that I sold. That's something I do pretty often, trying to get free plays, free contracts, and just seeing what happens. It's one of the best ways, I think, to get those multi-100% plays, like a 500% play or something, because you can take on a lot more risk and be a lot more aggressive if you know that your profits are the thing that paid for your remaining position. So that's one of my favorite things to do. You will see that a lot from me. If you're not already on here, then that is something that is pretty consistent with what I do, and I consider it to be one of the more successful strategies that I use, especially when getting those big plays. Tomorrow, all eyes are on the CPI data. This is something that's been waited for the entire week. I think that's part of the reason that we've pretty much just traded sideways this entire time, is they're just waiting on these numbers to come out because it is a main worry of the stock market, and to determine whether or not we're going into a recession or if this inflation is going to continue, if it's going back down. It has a lot of implications that affect a lot of things, and people are not a fan of high inflation for obvious reasons. I'm personally not a fan because I don't like to spend $70 at the gas station, but there's a lot of other reasons too. Like steak, for instance. I was buying steaks the other day and I was like, okay, yeah, hey, can I have this piece of this cow, please? And they were like, yes, you're just gonna have to take out a loan, sell everything you own, hand us the keys to your car, and then you may have a burger. And I'm like, well, no, I wanted steak. They're like, well, that's gonna cost you a child. And I was like, I don't have a child, so I just left. Either way, this comes out tomorrow. They're expecting 8.3%, which is not a very good expectation. The expectation, people are excited that it just wasn't higher than the expectation. So if tomorrow it comes out at 8.3, that's going to be relatively reasonable. I do not know how the market would react to that, because that means it's not going down. So 8.3 was what it came down to after the March report that came out in April. So it was 8.5, and then for the first time in a few months, it actually went down to 8.3. So they thought, okay, maybe 8.5 is the peak. But if it's still 8.3, then I don't think anyone is going to be excited about that. If it pushes up to 8.4 or 8.5, if it's 8.6, I mean, you're going to see a really, really, really bad day tomorrow. Because if it comes out higher than it was in March, then that basically means that April was the fluke and there was never really a downturn. And there's a big argument to be made for the fact that it shouldn't go down, and it probably won't. I personally think that they're going to miss the expectations and be a little bit higher. And the reason I think that is because I don't think oil has peaked yet necessarily, and oil is a driving factor between a ton of expenses. Oil itself is still going up. There's really no sign of slowing down there, and that makes everything else expensive, coupled with the supply chain issues and other things like that, just mismanagement from different government entities or whatever you want to blame it on. I don't know if we're going to have a very good reaction to whatever comes out tomorrow, and that is why I'm holding those puts into tomorrow. But I do have that call on the side that will hedge against that a little bit. So if we do surprise and inflation goes down again from the previous month, then we're going to see probably a really, really green day, and I'll have that one $200 play that will hopefully hedge some of the losses out from the losses from the puts. But we already took a bunch of profit on the puts, so we can't really lose money on those. That's pretty much the main thing that I'm looking out for. If you do like these videos, drop a like, subscribe to the channel to get more of them, and if you want to get the alerts, like I said, the link for that is below, and it's completely free to try. I will talk to y'all tomorrow. Thanks.